recording. I want to just remind everybody of a few things. You know, we don't have a class on Tuesdays, obviously, but I don't, you know, I feel like I should at least just mention this. I don't know if you guys know, if your other professors may have told you, if you are in a Tuesday or Thursday class, that tomorrow, Tuesday the 23rd, is an irregular day. They're making up for the loss of the Thursday of Thanksgiving. So although tomorrow is actually Tuesday, the classes are going to follow a Thursday schedule. All right. So, I mean, maybe that doesn't change your life at all. Maybe you have classes, the same classes on Tuesdays and Thursdays, but maybe it does, because if you have one class that usually meets on a Thursday, it's going to meet tomorrow. And that is, you know, it can be very disruptive if you had other things planned, or you thought, you know, you had the day off tomorrow or something. Your Thursday class will meet tomorrow unless your professor has told you otherwise. Any Thursday class that you have is meeting tomorrow. Is that clear? I don't know if anybody, it's very strange, but this is what CUNY does. They like make one day into another day. And I know that can sometimes mess with people's work schedules or other things, but just in case no one told you, I just wanted to make sure that you guys know, even though we don't meet tomorrow, the 23rd is a Thursday schedule. Questions or concerns, or are we good? Seems like we're good. Everybody knew what was happening. That's great. And then I guess just, you know, it's my practice to always just try and go over where we are on the calendar, just so that no one gets left behind for some reason. We're here, the 22nd, we'll finish up chapter 12 today. And then your homework for chapter 12 is going to be due by 6 o'clock on Friday. So, you know, you'll have the whole week basically to grapple with the material. If people, you know, are concerned that they can't turn it around, I can extend, you know, if anybody needs me to extend it to Sunday, I can. It doesn't bother me really. It's just that as we get to the end of the semester, you know, we're getting really close to where there's still 2 chapters of homework to do. So I don't want to extend the homeworks too far. If, you know, if people are you know, struggling to finish. I just know that it's obviously Thanksgiving. If people spending time with family, you may not have as much time to do the homework. And chapter 12's homework is important because it's, you know, it's going to be in the final. So let me know in the chat if you already anticipate that you need an extension. If 1 or 2 people tell me that they need more time, I'll gladly extend it, but I can't extend any of the other homework. So things are going to start smushing, you know, together because of extending deadlines. So again, if you know that your Thanksgiving, if you know that this week is busy for you, because remember we also have the term paper to submit, and you think Thanksgiving is going to be busy, I can extend this to Sunday. Just let me know in the chat if you need an extension, and I'll just extend it for the whole class. And those who can finish it on Friday, finish it on Friday. And those who need an extra 2 days, take the extra 2 days. All right. So tell me in the chat if you want me to extend the chapter 12 homework to Sunday. On Wednesday, you've got the final submission date for the term paper. Points will start being deducted if people are late, all right? You will get penalized. You need to submit the term paper by 6 p.m. on Wednesday. I'll talk a little bit more about that close at the end of the class to remind you again about the citations and stuff, because again, if you didn't submit drafts to me and you're going to submit your final paper on the 24th and you haven't cited your sources and so on, you're going to get a very low score or possibly fail the term paper. So please be aware of that. And then, yeah, so we've got the term paper due on Wednesday at 6 o'clock. We've got the homework obviously due. Sorry. the homework for chapter 12 due, and we'll finish chapter 12 today. Just a reminder that as we turn the corner here to the end of the semester, for anybody who needs to, I don't know that anybody needs to withdraw from this class. I think you guys are fine, but I'm just saying if you're having issues in some of your other classes, or you suddenly feel like you won't be able to make it, consider an incomplete in a class, or if you absolutely have to withdraw from a class, the last day to withdraw is the last day of classes, which is December the 8th. All right, the 9th is reading day, and then the testing starts on the 10th, but I opened our exam from the 9th in case people just want to finish it and be done with it. All right, so any questions on the calendar, or anybody need any further clarification about due dates?
Professor, I do have a question, but it's not about this due date.
Go ahead, you can just ask it. Unless you need to ask it to me after class, or is it?
No, it's a short question. So yeah, about the YouTube videos that you uploaded, will you keep it forever, or are you gonna delete it? Because I feel like sometimes I might need it. I want to go look back at it.
Yeah. No, I don't delete them. I generally just leave them there for better or worse. I don't know. But I don't have the time to go through and delete them. So I just it can be there. I even sometimes refer people. I don't have this class online. This class doesn't have by online, I mean online asynchronous, but I sometimes even refer people, from other classes to look at the stuff. So yeah, it will be there into perpetuity, no problem.
Okay, all right, thank you so much. Yeah, because I really need it.
Yeah, no, you're welcome. And some people will actually, just 1 second, some people will actually hit this material again at the 4-year school. Normally that's what happens. You start with intermediate accounting, and so maybe it will be of some value when some of the concepts get a little bit tricky. Yeah, I'm happy to leave it.
Okay, thank you.
I'm glad it's useful. I don't really check to see if anybody's looking at it. Maybe I should.
I will look at it, Professor. I will.
Okay. Sharon, what's up?
Don't close the Professor Blackboard class, because if you close this class, we can't see anything. So don't close it.
I have to close it at the end of the semester.
So if you close the class after the end of the semester, we can't access the class.
And I know, but I have to do it. I can't leave the class open when the
maybe you should save those documents.
That's what I was just going to say. You download everything that you think you need, but I will absolutely have to close the class, because once the semester is over, it's not a policy to leave the class open, because then in the end, what could happen is that, people are accessing things that are either irrelevant, or sometimes I also get confused between classes and send notes out to the wrong people because it looks like the same class. And then the last part is that if I'm teaching this class again, I can't leave the materials like from the previous class, because then what ends up happening is people think like, oh, I just have all the materials, I don't need to attend, or I don't need to pay attention, or whatever. And I mean, as you guys can tell, just by having the lectures, you absolutely do need to be here to get the explanation. So that's a long explanation, Jaron. But from a campus policy perspective, I have to close the class. If there's something that you need and you're not able to download it from here for some reason, you can always email me and ask me for it. But definitely download everything. That I won't be able to leave open. The YouTube I can. Okay.
Okay, and we can find your lecture video in YouTube. We can't save this one because
you can download it. But I mean, I'm not gonna. You should be able to download my lecture videos just like you can download regular YouTube content, but I'm not going to close that out. So if you subscribe to my channel, those lectures will be there forever.
Oh, okay.
For better or worse, as I said. Okay. Yeah, so you can find me for sure on YouTube, but Blackboard by about like January, the beginning of January, I'll shut down this Blackboard. Okay. Madeline, you have a question?
Yes, and then what about the McGraw-Hill Connect? Like how long?
Yeah, that's a good question. Let me check here. I believe that I believe the date is actually on the landing page. Just one second. Yeah, December the 16th. So 2 days after, 2 days, or I may actually need to extend that a little bit because I may still be collating the grades, but 2 days after the exam is due is when Connect is gonna close out.
Okay, thank you.
Was there anything that I'm just trying to make sure I understand if there's something that you needed or if I could help in some way.
No, I was just curious because
okay, gotcha.
I know when I log into my McGraw-Hill, I see like the previous class, but I've never seen if it's still there.
Okay. Yeah. So I don't know how McGraw-Hill works. I know that Wiley is like you can't be in 2 sections at the same time, 2 sections of the same thing. So I would shut out McGraw-Hill Connect because some of you will transfer to let's say to Baruch or Queens or whatever at the end of January for the spring semester, and you may end up going into an intermediate accounting class, and then you need to maybe be on McGraw-Hill Connect, and then you can't maybe exist in 2 classes at the same time. All right, so I'll definitely shut that down as well. So the only thing that will remain is YouTube. Thanks, guys. This has been helpful to discuss this and see where the value lies for people. Anything else about dates and times and chapter 12 homework? Do you guys think you need extra time, or are you solid to finish it by Friday? Any opinions?
No, Professor.
Okay, one person saying no. Okay, so I'll see how it goes. I'll check in on McGraw-Hill to see how many people have done the homework by maybe by Thursday, and if there's a problem, then I may extend it unilaterally because again, I don't mind. All right, so we know what the deal is with what's due. I just, again, want to encourage you, the term research paper is nothing to be, trifled with. It's 15% of your grade. Please don't plan not to submit it and don't plan to be late. I will deduct points for lateness. For every day that the thing is late, points will be deducted. It's not just one global point, or there'll end up being a cap on the grade that you can get. So I specifically give an early deadline to try and eliminate lateness. So please just send me your paper by 6 o'clock on Wednesday. All right, and again, I'll see what time we have at the end to just go over this again, but I'll do it at the end, the discussion of the term paper, because those who have already submitted can then drop off the call if they don't need to, stay and talk about that. All right, so we find ourselves back, right back in chapter 12 and trying to finish up here with all the work related to equity investments. So I'm just going to give a slight refresher because it can be hard to move between Wednesday and Monday and remember everything. So, two types, well, not 2 types of investments that we will deal with, but actually 3 types of investments total, and we look at them by percentage. The first type of investment is a holding less than 20%. And for this type of investment, you do have to fair value the investment, and all fair value adjustments go through net income, right? Then you've got the second type of investment is called equity method. We haven't done any examples on this yet, but we will today. That's for holdings of 20 to 50%, where you have significant influence over the operations of the investee. And so there you do a slightly different type of accounting than what you do for the first category. And then the last one is if you own more than 50% of the investment, you have a controlling interest. And so you consolidate the investment, meaning that you bring all the assets and all the liabilities, revenue and expenses, everything you add from the investee into your numbers as if you own everything, and then for the percentage that belongs to someone else, you take that out separately. Okay, so you basically treat that investee as if it's truly a part of you. We won't deal with this stuff, you know, deeply in our work. It's outside the scope of this class, but when you get to your 4-year schools, you'll definitely do a lot of work around consolidations. I know that because, I mean, obviously I've done it myself. So, you know, just to refresh again, the types of things that you should be able to do to account for investments. You need to know the journal entry for buying the investment. So you just debit the investment, credit cash. What happens when you receive dividends, right? And we'll talk here about the difference between the way dividends are accounted for in category 1 versus the equity method. And then, you know, where do the unrealized holding gains and losses go for fair value adjustments? And then what happens when we sell the investment and unrealized gains and losses become realized, right? So again, refreshing, when the investment is less than 20%, you record the investment at cost. Okay, cost and fair value at the date of the purchase should be the same. So whatever they say is the cost, that's just it. That's what you record. You don't have to wonder if there's a fair value out there for the investment that would have differed from cost. Any dividends that are declared or recognized in income, so it's dividends revenue, right? Debit cash, credit dividends revenue. That's how you treat that, and we'll get into more examples around that. And then unrealized gains and losses, as I said, they'll go into net income. So this is almost like you know, when we did debt investments and we had trading debt investments, those unrealized gains and losses went through net income, same idea. And then you also use this fair value adjustment account. We were doing it last time. And then when we sell these types of investments, right, we do any further fair value adjustments up to the time of the sale, and then we don't have to record any gains or losses, you know, for the sale, because all the gains and losses have already been adjusted for up to the sale. That's the word I was looking for. So I'm just going to take us back, not way back, but kind of back to let me see if, yeah, let me just go right back to this exercise 5 or example 5, right? I'm just going to work through quickly because you guys already kind of know this, but I just want to make sure that everybody is on the same path here. So example 5 had a purchase of an investment of 50 million, right? The company had net income of 80 million. The fair value at the end of the year was 35 million. So there's obviously a 15 million drop. And then they ask you to make all the journal entries related to the investment. Oh, and there was no dividend, pardon. And then at January the 20th, they sell the investment, right? So this was number 5. So for the purchase of the investment, you debit the investment, you credit cash. For an investment that is less than 20%, you do not record anything to do with net income. I'm emphasizing this because we will soon move on to equity method, at which point we will actually record things related to net income. For dividends, there were no dividends for the year, but if there had been dividends, they would have been recorded as dividends revenue. Then, you know, this methodology of calculating fair value adjustment and so on is pretty useful for really just about any question. So, you know, this is saying what was the fair value at the end of the year, 35 million, what was the cost, 50 million. So there's a loss of 15 million, which will be the ending balance on fair value adjustment. Since you just bought this investment, there's no beginning balance. So the adjustment that you have is 15 million. And this is on the minus side. So this is telling you that the fair value is less than the cost. And it's a loss on the debit sides, right? Going through net income. There you can see the net income piece that we're talking about. And then they tell us that the investment was going to be sold for 30 million on January the 20th. So what we do is we update the fair value adjustment. We take what we're going to receive for the investment, we treat that as the fair value, right? Basically, the cash that you're going to get is the fair value. You compare that to the original cost, which tells you that the ending balance on the fair value adjustment account needs to be 20 million. You know that there's already a 15 million right balance, so 5 million is the additional adjustment that you need, and that's what you do. So at this point, you've recognized all the losses related to this investment. So now you do the sale. You basically, you know, debit cash 30 million. you debit the fair value adjustment account to get that out of, out of to get rid of the balance. Sorry, I'm struggling with my words this morning. And then you credit the original cost of the investment. And so if you're concerned about what about the fact that you're not recognizing gains and losses on the sale, you've already recognized all the losses in net income. So you don't have to recognize them in net income again. So those are the four, I guess it was 4 steps that we have to be able to deal with when we're talking about the recording of investments. Anybody have anything to ask here or clarification points? I'm kind of just rounding out our work and reminding us where we were before the weekend so that we can all start from the same footing. Any questions here? All right, looks like I don't see any hands raised. Okay, looks like we're okay. So what I'm gonna do is for a minute here, just skip over some of the additional examples for fair value adjustment account. We'll come back to them, but I'm actually gonna focus quickly on equity method and make sure that we have that under control before we just, spend the rest of the time together practicing, for various scenarios. All right. So we're switching gears now, okay? We dealt with holdings less than 20%. Now we're moving into holdings of 20 to 50% with something called significant influence. This is a defined term. It's not something that I'm making up. You'll see it in your book as well. It's saying that the investor is owning somewhere between 20 and 50% of the investee, but the investor also has some say over what the investee does with their earnings. Okay, this is what significant influence means. So it could be something like the investor has a seat on the board of directors of the investee, or they have some other impact on operations, right, of the investee. That's significant influence. And when those conditions exist, right, holding of 20 to 50% with significant influence, then we follow what is referred to as equity method accounting, okay, for the investee in the books of the investor. So I'm going to show you how to do equity method accounting. First, we'll go over the theory, and then we'll do some examples to reinforce how to do this, the journal entries and figure out the balance on the investment and so on. All right. So same as before, the investment is initially recorded at cost. So whatever you pay for it, you debit the investment and you credit cash or whatever, however you paid for it. It's more likely than not that it will be cash. So debit equity investment and credit cash. And now, things become a little bit different over here with dividends. The dividends are not just treated as dividends revenue. The investment account, the actual investment account is, well, let me actually take earnings first, because the earnings come before the dividends. So when there's net income in the investee, the investment account will be increased by the amount of net income. If there's a loss, we decrease the actual investment account. So that means that for equity method, you do include net income and net loss amounts for your percentage of the investment. You do include it in the balance of your investment. So that's a little bit weird, and I think it will make more sense when we do an example. But what I want you to remember is you do have to think about net income, net loss. You have to think about your percentage of it, and you either add it to the investment balance or you subtract it from the investment balance if it's a loss. And then if there's any dividends that you receive, you will also subtract those dividends. So let's just think about what they're trying to say. They're basically saying is you buy this investment, right? And because you have significant influence over the investment, you are entitled to some portion of the income of that company. So you add your portion of the income of that company onto your investment balance. Then if a dividend is paid, a dividend represents a distribution of some of the income, right? So you will then subtract any dividend that you get from the investment balance. That's how you treat it. And so, you know, if you, I don't know if there might be a way to write this out that's a little bit less dense, because I feel like the writing in the notes is very dense. So if you, again, if you think of equity method, right, the way you think of it is, this is the investment cost is where you start, right? Then you add then you will add net income, but only your percentage of the net income, right? And if there's a loss, I mean, both can't exist at the same time, but if there's a loss, you subtract the net loss, but only, again, only your percentage of that net loss. And then if there's any dividend, you subtract the dividend, and you already know what I'm going to type. I should have just put your percentage right at the top here, right? Your percentage of the dividend, you will subtract, and then that equals the ending balance on the equity method investment. So that's kind of the shorthand way of thinking about it. I feel like what's written in the notes is a little bit long-winded. It's saying the same thing, but this is an easier way to do it, right? So this is where you start with the investment cost or the beginning balance. Right, if you didn't just buy the investment, it may be a beginning balance of the investment. If you've had the investment for a few years, right? That's where you start. You add in your percentage of any net income, or you subtract your percentage of any net loss. You definitely subtract your percentage of any dividend, and that equals the ending balance. So this is how we're going to be accounting for equity method, which is very different to what we've been doing with the holdings less than 20%, because there we don't even consider anything to do with net income or net loss, and the dividend is not subtracted from the investment. It's just treated as dividend revenue, okay? So this is a very different approach that's happening here. And it's because of the ownership percentage that's different. That's why we have to do this. And so let's just skip over bullet number 3 for a second, because it's a little bit long. When the investor's level of influence changes, no adjustment is made to the remaining carrying amount of the investment. Instead, the equity method is simply discontinued and the new method applied from then on. So what does this mean? Let's say you own 30% of an investment and suddenly circumstances change and now you only own 10% of the investment. You just stop equity method accounting and start doing a fair value through net income. You don't have to adjust the investment balance. I'll repeat. Let's say you owned 30% of an investment. You were doing equity method. You have an ending balance on the investment. You decide to sell 20% of the investment and you only have 10% left. You don't have to adjust anything from what you accounted for before under equity method. You can now, from that date of sale, you can just start accounting for the investment at fair value through net income. Right, then it's not like you have to go back into your books and change everything to fair value through net income, because everybody knows that this was an equity method investment and now it's changed to something else. Okay, so everything that happened before is fine. So you have a D missing over here. So that's what that bullet is saying. And now the opposite. If you had a 10% investment and you buy another 20%, and now you've gone from fair value through net income to equity method, right? You don't have to go back and treat everything as equity method before, because you didn't have that percentage ownership. Just from the day when you buy the extra percentage, you will now account for the investment as equity method. So everything is that word that we had before, everything is prospective, right? Everything is happening from today forward. You don't have to go back and change anything from before, because you did not have that ownership percentage before. I hope that's clear, right? Prospective changes in your accounting. And what if, and you sometimes see this, especially when companies are invested in like foreign companies, let's say an American company invested in a foreign company in another country. I'm from South Africa, so I think about some of the stuff that happens there, and sometimes you find that investments look lucrative and then the government does something or whatever and things change. I'm sure you guys can think about circumstances in the countries where some of you are from, where, you know, something looks like a good idea and then the government just decides to change, you know, to put in some law. Like this was happened in China now, where they just banned, you know, crypto mining. So, right, so you're invested in an investee and suddenly like the net income dries up. Right, they're making losses and they keep making losses. So then the question becomes, for how long should you recognize those losses, right? You can only recognize losses up to the carrying amount of the investment, right? So let's say you paid $10,000 for the investment and the investee has been making profits all along. You will recognize losses until you wipe out all the profits. Then you recognize losses until you wipe out the 10,000 initial investment. And after that, you will stop recognizing the losses because you can't push your investment into negative territory, right? So it's saying, you know, that you'll have to stop once you've wiped out the carrying amount of the investment, which makes sense because again, you can't have a negative balance for the investment on the balance sheet. If it turns out that the investment is actually impaired, it's not just losses that are temporary, but there's an actual impairment, like the business is probably just not going to work out or whatever, then you will have to take one big impairment loss and write the investment, you know, the carrying amount or whatever the fair value is of the investment. Maybe you realize that circumstances are not going to change, you know, on this investee. So you have to take an impairment loss. It's like all the other assets that we dealt with, right? In chapter 11, it's an asset. This investment is an asset and you have to test it for impairment. And if there's impairment, then you'll have to write it down to fair value. And then when we sell the investment, we will recognize a gain or loss, right? If the selling price is more than the book value of the investment. That makes sense. Book value is what you're carrying it at. If you can sell it for more than that, then there will be a gain or a loss. Okay, so those are some of the major pointers. And then this thing that I was saying that we're just going to skip over for a second. There is something dealt with in the book. You know, it's kind of a smaller topic and we won't really do examples on it, but I just want to mention it so that you don't think when you're reading the book that you don't know what this is about. When an investor buys an investee, an equity method investee, they will, you know, fair value all of the assets and liabilities to see, you know, what they think the investment is worth. And they're obviously paying an amount based on, you know, the fair value that they've calculated. But the investee in their books is still carrying their stuff at book value, all right? It's you know, they don't change their books to reflect fair value. So what this bullet is talking about is sometimes the investor has to actually make some adjustments to the net income or net loss of the investee that they recognize in their own books because of the difference between book value and fair value of the investments. And those adjustments are are often related to depreciation. So I'll repeat because that was a very difficult concept, right? Let's just take two company names, even if it doesn't, even if it's not true, it's just easier to think of it. So we know that Amazon bought Whole Foods, right? I think they bought, you know, controlling interest, but let's just pretend that it's an equity method investment. So Amazon buys Whole Foods. When Amazon buys Whole Foods, if you remember this from how to calculate goodwill, they will look at the fair value of all the assets and the liabilities, and they'll pay a price based on fair value. All right. But Whole Foods, because it's operating under generally accepted accounting principles, Whole Foods will not change the amounts in their books to fair value. They'll still be carrying it at book value, all right? And so what ends up happening is when Amazon brings net income or net loss, right? Net income or net loss into their investment balance, based on the numbers that Whole Foods is generating, they know that the depreciation, for instance, is based on book value and not based on fair value. But when they paid for the investment, this amount, this was a fair value, right? The cost is fair value. They paid based on fair value. So sometimes, and again, you'll see it in the book, sometimes what ends up happening is that the companies will actually adjust this net income or net loss amount that they get from the investee to add some extra depreciation or add some extra amortization, because the numbers that they have as investment cost is based on fair value, but the net income and net loss are based on book value. All right, so that's what that adjustment is about. Will I put it in your, you know, an example where you have to do it for a test? Absolutely not. It's a little bit of a smaller topic, so please don't worry about it too much. But I know you guys are going to run into it when you read the textbooks. I want to make sure that we talk about it so you don't get bogged down trying to understand something that isn't, you know, maybe the biggest part of this chapter. And then, you know, the book will also tell you that there's no adjustment for land because land is not depreciated. So the fair value, the difference between fair value and book value of land is not going to affect net income or net loss. And then there's also no adjustment for goodwill because goodwill is goodwill. All right, so that's what that third bullet is about. Any questions on the theory? I know it's a little bit dry, but we have to, you know, understand how to account for this thing before we actually do examples. Anything that I need to explain further, or I'll just give you a minute to process until 11:15, and then maybe people have questions for me. All right, so I suspect more questions might come. Excuse me, I need to drink some water. I don't know what's going on with my throat, but more questions. Oh, hey, someone's talking to me in the chat, sorry. You mean for you're asking me about why goodwill is not included in the adjustments? Sure, because the goodwill of the investee that's on the investee's books is not being amortized. So the investor cannot adjust for goodwill in terms of amortization because there's no amortization for goodwill. If the investee finds that the goodwill is impaired, the loss will come through as part of net income anyway. So when we're talking about adjusting for goodwill, I don't know if I was clear enough. I'm talking about adjusting for goodwill that exists on the books of, in our example, of Whole Foods. So Whole Foods could have goodwill on its books from other companies that it had acquired, you know, once upon a time. But when Amazon buys Whole Foods, right, and they pay fair value, they're also acquiring that, you know, that they're acquiring the company so that they know that goodwill exists, but they won't adjust for the goodwill because it's never amortized. And land, it's kind of the same thing. Land is not depreciated. So there's no adjustment that Amazon can make for the land either because Whole Foods is not depreciating the land. They're not amortizing the goodwill. All right. Thanks for asking that. I think maybe I could have been a little bit clearer when I was mentioning goodwill, I should have mentioned whose goodwill I was talking about. Any other questions? And let me see if I'm still logged in here or if I've been tuned out. Okay, I'm still logged in. Let me just go and show you where in the book. I'm not gonna spend a ton of time on it, but I just want to show you where in the book, if people are still stuck on this whole adjustments thing. Excuse me. Yeah, this is in the book where they talk about, you know, the further adjustments, the land goodwill, the additional depreciation, other assets and liabilities. Okay, so if you want to check it out, you can, but like I said, it's not a big part. The bigger part of this is actually being able to do the equity method accounting, which we're about to do here in a second. So yeah, we'll start with, so I'm skipping over 7, 8, and 9, just because they're extra practice for the fair value adjustment account. We'll come back to them, time permitting, but I'm going to be focusing on 10, 11, and 12 for the purposes of us making sure that we know how to do equity method accounting. All right, so the first example, excuse me, will be exercise 10. And remember, the point of what we're doing here is to try and figure out the journal entries around equity method accounting. And then also, if we do need to calculate the balance on the investment, we will do that as well. All right, so Zoop Corporation purchased $300,000, purchased for $300,000, excuse me. So here's the cost of the investment, right? A 30%, so immediately you need to sit up and take notice and realize that this is more than 20%. So it's an equity method investment. Interest in Murphy, Inc. That's the investee, this is the investor. This investment enables Zoop to exert significant influence. There's the, you know, the words, remember I told you this is like a defined, kind of a defined term. And, you know, 2 words that you expect to probably be mentioned around equity method accounting. So they have significant influence, they have a 30% investment. During the year, Murphy earned net income of $180,000. So this is the total income. So you have to be careful. The simple mistakes that people make. Sometimes they say, oh, 180,000, so that's what Zoop needs to record. No, Zoop only owns 30% of this company, so you still have to apply the 30% to the 180,000, right? And they pay dividends of 60,000. Again, this is the total difference. You still have to apply your percentage. Prepare Zoop's journal entries related to this investment. So this is where you need to, you know, have your theory under control, because you need to now remember that there's a difference between equity method and fair value through net income. With fair value through net income, you don't record the net income numbers of the investee at all. You just record the cost of the investment and the dividends. But with equity method, which is what we're going to do now, we record the cost of the investment, we have to record the net income, and we have to record the dividends. All right, so you have to make sure that you have that clear in your mind in order to process these journal entries. So this is the question. Hopefully everybody's either downloaded the sheet, or if you haven't, please take a picture of it, because I'm going to go between the solution and the question. All right. So exercise 10, I'm working on our trusty little Google Doc here. So the first thing that's happening, I have the question over here also. There's no dates, so I don't really have a date to put in, but the first thing that's happening is the purchase of the investment. So you debit equity investment, and some companies will actually put the name of the investee so that they can keep track of their different investments, all right? And so it obviously costs $300,000. You didn't have to apply the 30% to the 300,000 because it told you that there was the investment was purchased for 300,000. So that's the purchase of the investment, and I'll put that on top. Sorry, so we know what's going on. So the purchase of the investment. Any questions up to there? All right, now the second step is to record the net income, right? So remember, we're following this approach up here of all the things that we need to do. So record the net income. Remember that it is 30%, right? You want to you don't want to forget that. Otherwise, you could fall into the trap of recording everything. So here we have to be careful. Okay, the net income is not being received in cash. Okay, net income is only received in cash if there's a dividend that's being distributed and paid in cash. You do have to add the net income to the cost of the investment. So how you do that is you debit the investment for the net income amount. And that feels a little bit weird, right? Like, why are we debiting the investment? But we're saying the net income that the investee is earning is, you know, somehow attributable to us. So we add it onto the investment balance, even though we haven't received any of that as a dividend. It doesn't matter. It belongs to us. And the way that we show it belongs to us is that we debit the actual investment. Very different to fair value through net income, right? If I'm invested in, I have a few shares in, let's say, in Apple, I'm not adding Apple's net income onto my investment because my investment is too small. But if I owned 20% or more of Apple, I would add their net income onto my investment if I had significant influence. So what's the number? It's going to be, it's going to be the 180,000 of the net income multiplied by 30%, right? If you go back to the question, you see net income was 180,000, and your 30% is all that you can record. So 54,000. All right. And this is, again, there's no cash involved here. You debit the actual investment asset, and then the credit goes to income. So you actually do record some type of income. It's investment income. So again, new information, new approach. Please be careful here with the account names, right? The investment income is a new account for us. Questions for that one? All right, now you record the dividend. What did we say right at the beginning here? You subtract dividends from the investment balance. So you should be anticipating that we're going to credit the investment for dividends. Again, I'm just writing the 30% here to remind myself not to take the entire amount. A classic mistake that people make, right? To take the whole 60,000. So they paid dividends, which means cash was actually received. If it said that they declared dividends, you would have a receivable. But because it was paid, you can actually record cash. So I'm debiting cash because my cash would have gone up for the amount of the dividend. So it's 60,000, right? 60,000 multiplied by 30%. That's the amount of the dividend. 18,000. And so yeah, because we subtract dividends from the investment, you are going to credit equity investment of Murphy with the dividend, with the dividend amount. $18,000. Questions, anybody on the dividend? All right, so what I think is useful, although it's not asked for, is to calculate the ending, right? The ending balance on the equity method investment. So you guys calculate it, and then afterwards someone throw out a number, and then afterwards I'll show how to calculate it as well. take a minute and come up with what you think the ending balance should be on this investment. Anybody have a number? If you have it, you can put it in the chat. If you have a number that you think is the investment balance after all of these journal entries. So we're calculating the ending balance on the investment in Murphy. Yes, Madeline, it's 336,000. So can you, if you are able to turn on your sound to tell us what you did. If you can't, that's okay. Just let me know in the chat.
So I added the 54,000 to the 300,000 because we add the net income, but we were supposed to subtract the dividend, the 18,000.
Yeah, thank you. So you added the investment cost, you added the net income, and you subtracted the dividend. Perfect. And I'll show, so hopefully everyone followed what Madeline did as well. Thank you. I'll also show it quickly. Oh, sorry, just before we go on break, I'll show it on a T account for those who maybe want to see, well, if I can get anything done here. So this was the purchase, right? 300,000. Then we've got the net income. These are all additions to the investment, 54,000. And then you've got the dividend, which is a subtraction, 18,000, right? And investments and assets, so it goes up on the debit side, down on the credit side. And then to Madeline's point, the ending balance, right? You add the cost, to that you add the net income. As Madeline said, you subtract the dividend. So you end up with a balance of 336,000. And that's the balance that will show up as the equity method investment on the balance sheet of this company. Questions, anybody, confusions, things that you need me to resolve for you? All right, so let's break here. Let's come back at 11:42, at which point we have a few more examples like this to do before we close out the chapter. Okay, so you've got a 10-minute break until 11:42, and then I'll just talk about, we'll do some more examples and I'll talk about the fair value option, right? I'm here if people need me for something during the break. Oops, that was unintentional. To just See, we'll see how that this thing is so huge. So we're back from the break. We'll move on to the next example, number 11. And what I'm going to do is read it with you and set you up, and then have you guys do journal entries and calculate the ending balance to see if the stuff is sticking right in your mind. This is a slightly different scenario here in number 11 because the company, this isn't the first year with the purchase. The company already owns the equity method investment. So we'll see what we need to do. So Foucault Company owns 40,000 of the 100,000 outstanding shares of Mango Inc. So what percentages is that, anybody? What percentage do they own of Mango Inc? You can put it in the chat or you can just shout it out.
%40.
Thank you. So 40%, thanks, Madeline. So 40,000 divided by 100,000 is 40%, right? 40% of the outstanding shares. So now we already know, Madeline, right? Because you know it's 40%, that this is going to be an equity method investment because the company owns somewhere between 20 and 50%. That then means that you have to record your percentage of net income, your percentage of the dividend. And that was part of why we needed to calculate this percentage, right? Because we need to know what to apply, what percentage to apply to the net income and the dividend. So during 2015, Mango earned 640,000. That's the net income, and pays cash dividends of 480,000. There's the dividend. But remember, it's your percentage, right, that you will record. The balance of Foucault's investment in Mango at January the 1st, 2015 was 430,000. This tells you that they purchased this investment long ago. You don't have to make a journal entry for the purchase of the investment, but you do have to make a journal entry for recording net income, and you do have to make a journal entry for recording the dividend, right? So it says prepare the journal entries required to account for the Mango investment in 2015, and then calculate the ending balance in Foucault's investment account at December 31, 2015. So this is basically what we were doing before, right? Minus the actual purchase of the investment journal entry. So I'm going to give you guys 30 seconds here for those who don't have the document to take a picture of this or write down the key information. And then after that, I'll switch the screen to the answer to the previous question, and then I'll give you some time to answer number 11. Okay, so you have about 30 seconds to just either copy down the question or take a picture of the question or whatever you need to do. All right, so I'm going to switch to this sheet so that you can be reminded of how we can answer this question. And I will give you, let's say 10 minutes from now until 11:56 to answer the question. And then I'll take a volunteer to walk us through the solution, okay? You are answering question 11, 10 minutes until 11:56. All right, so that's time for 10 minutes. I don't know if you guys had enough time. Is there anybody who wants to? Okay, Madeline, you're on fire today. Love it. Love it.
So for his investment, it's gonna be 430,000. And then for his in his net income, it's gonna be 256,000 because we multiplied 40% with
Right.
640,000.
But bear with, let me catch up to you. So first of all, for the purchase of the investment, there's
Mhm.
not going to be a journal entry right now, right? Because we already own no journal entry in 2015 because we already own the investment. And I'm saying that because if you read this is the balance of the investment at January 1st, you see that is 430,000. So
Yes.
that means they bought it before. So I won't make a journal entry. I agree that the beginning balance is, let me write what you told me. The balance, I'm just making sure that everybody is, on point here. Okay, now let me record the net income with you. And you're right, it's 256, okay? So we're gonna record net income, 256. So the reason it's 256 is we own 40%, right? So what's the journal entry to do this net income?
So his net income 256,000.
What do I debit and what do I credit? That's what I'm asking.
Oh, hold on.
Mm-hmm. You can look here also, it's the same as the previous example.
Oh yeah, the equity.
Mm-hmm. Mm-hmm.
Yes.
So I also just want to mention, and I'll show it again. If you look in the book, for those who might be getting confused, the book uses a slightly different account name. And I'll explain it in a second. 640,000, right? Madeline times 40%. That's how we got to the 256 or 6. I just want to have the formula here also in case someone needs it. 40%. Okay. And then what do I credit?
And then we're gonna credit, hold on, the I'm sorry.
Mm-hmm. Yeah, you're right.
Yeah, investment income.
Mm-hmm. So again, the part A, you want to be careful here that you're actually answering the question, right? Because part A is asking you for the journal entries related to the investment. So it's good to have the amounts, but you actually have to be able to make the journal entry. So I just wanted to mention here, guys, that in the textbook and the textbook uses account investment in equity affiliate, okay? And so Connect may use the same. This equity investment with a company name is also acceptable. And many companies do it that way. Sorry, I missed out a T here. But just in case you're doing the homework and you're like, what is going on? Why can't I find equity investment as the name of the account? Investment in equity affiliate is also an acceptable account name, and that is what the textbook will use. Madeline, I've still got you on the line. Stay on the line. I see Pura is raising a hand. Go ahead.
And then we're going to record the dividend cash.
Just hang on a second, Madeline. Hang on a second. I just want to hear what Pura is asking me, then I'm going to take you again. Yeah, go ahead.
I didn't catch what the 40% was. Well, how did it come to 40%?
Oh, it's 40,000 shares. So do you see where it says at the start? Oh, let me go to the question, sorry. 40,000 of the 100,000 outstanding shares. So you got to do it.
Okay.
So the percentage ownership. Sorry. Let's just do this. I'm all over the place here, but it's okay. Is 40,000 over 100,000. And I'll look at a percent. Okay, so we know why that's the case. All right, thank you. Madeline, I'm back to you. What do I need to do now?
So to record the dividend, we're gonna debit cash for 192,000 and credit early investment for 192,000.
So cash is going to be 192 is correct. It's the 480, right? The 480,000, but limited to only 40%. Yes, and then equity investment, or like I said, the textbook will say investment in equity affiliate. It's the same idea. So either way is fine. Just if you've got drop downs on Connect, just choose the one that they offer you. They might offer you investment in equity affiliate. Okay, questions? Anybody else so far on anything? Yeah. All right. So those are the journal entries, right? That's part A, the journal entries that we needed. Now in part B, they're asking us to calculate the ending balance, right, on the investment. So we can do the T account, or we can just do a straight calculation. Madeline, do you have the ending balance? You want to tell me what to do?
Yes. So it was 494,000.
Yes. So did you start with the, yeah, sorry, go ahead, talk, yeah.
No, well, since the beginning was 430,000, we added the net income of 256 and subtracted the dividend of 192,000.
That's right. Add net income of the 256 debit up there and subtract the dividend, which is the credit over there. So we know it's a subtraction. And so the ending balance, you can do it this way. I'm showing you both ways. You can obviously, the T account that I did before is going to end up on the same balance. I'm just showing you that either way will give you 494, which is what Madeline was saying the balance is, which is correct. Thanks, Madeline. Questions, people? We're good? So take a moment to process what you're seeing, fix your answers if you need to, recalculate things, figure out where the 40% came from. I did it over here, or whatever you need. I'm going to give you until 12:05 or 12:06, depending on when the clock turns over, to just ponder on this, and then we'll just do another example. So take a moment. All right, so hopefully everyone's up to scratch now with what we're doing. I suggest when you get an equity method question that you just go through all the different journal entries to make sure you're not missing something. But remember, we don't journalize beginning balances. So the fact that this question said that the balance was already there. That doesn't mean you need to make a journal entry. Look how that's different from this one that says they purchased something, right? When it says that they just purchased it, that's when you make a journal entry for the purchase of the investment. And then the other, I think, you know, again, as I said before, this is a typical mistake that people make. You have to apply the percentage that you actually own to the net income and the dividend. You can't just take the entire amount. You don't own 100% of the company. All right. Fine. So let's look at number 12, and it really has two scenarios. The second one is a significant influence equity method. So I'm gonna read this and then I'm gonna have you guys work this out again on your own to continue to solidify this information in your minds. And then after that, we'll just go over one or two more things and see where the time leaves us, okay? So number 12, situation 2, Monica Inc. obtained, there's the language, oh, sorry, I don't know what I just did here. There's the language again, obtained significant influence, right, over Sellers Corporation by buying 32%. So you're given the percentage here in the question, so you don't have to calculate it like the previous one, of Sellers' 32,900 outstanding shares of common stock. Okay, so how many shares did they actually own? That's the question now. Let's calculate how many shares did they actually own. If they bought 32% of 32,900 shares, how many shares did they actually own? You can write it in the chat or you can just shout it out.
Is it 10,528?
Yes. Yes, so let's see how we get there. Let me bring up my trusty, huge calculator on the screen here. So it's just 32,900 is the total number of shares, right, of sellers. And 32% is what they bought. So 10,528 is the number of shares that they actually own. Why do we care? Because they tell you how much they paid per share. So you have, if you just multiply straight the 32,900 times 9, you're acting as if they're buying all the shares and they're not, okay? So you have a little bit of a calculation to do there at the beginning. So notice how these questions are presented to us differently. In one example, they told you, like up here, they told you it was 30%. Over here, you have to calculate 40%. Over here, they tell you it's 32%, but they don't tell you the total cost that you paid. You have to calculate it by multiplying out the shares and then the dollar amount per share. On June the 15th, sellers declared and paid a cash dividend of $41,000. Remember, you still have to apply the 32% to that. And then on December the 31st, sellers reported a net income of $87,400 for the year. There seem to be no instructions here. I don't know what happened. Maybe I cut the question off by accident when I was putting it into the into this thing, but the instructions would prepare the journal entries, obviously, right? Prepare the journal entries for the situations about, all right? But you're doing situation 2 right now. That's what I'm asking you to do. So situation 2, prepare the journal entries. It's a equity method investment. I'm going to give you again 10 minutes until 12:20 to do it. And, you know, remember that you have to, I just showed you, let me bring up the calculator again. This is the number of shares that they bought. They bought the shares for $9 per share. So you do need to record the purchase of the investment. You do need to record net income, and you do need to record the dividend, okay? So you've got until 12:21 to do these 3 journal entries. Let me know if you need to see the previous work or not. If you have questions, feel free to put them in the chat if you got stuck or something. There's a minute left. All right. Is there a volunteer who wants to walk us through the journal entries for this? Okay, Madeline, you are doing it all day. Thank you. Let me just sit myself up here. So exercise 12.
No problem.
Situation 2. Okay, so we're going to start with the purchase of the investments, right, Madeline?
Correct. So for the equity investment, we would debit $94,752.
And what are the account names? What account names are you going to use?
Equity investment?
Mm-hmm. Sorry, okay, I just thought you meant, sorry, I understand now what you were saying. Okay, for sellers, and remember, I'm just pointing out again in the book, you'll see investment in equity affiliate, it's the same thing, okay? So if you're on Connect and it's giving you options for account names, just use the book name, investment in equity affiliate. So 94,752, correct. And then what do you want me to credit here?
Cash for $94,752.
Same. Okay, what's next?
We're going to record the net income. So the equity investment for $27,968.
Yes. So we're recording net income. It's at 32%. So you're going to do the equity investment debit for $27,968.
And then credit the investment income for $27,968.
Okay. Next.
And then now we're going to record the dividend cash for $13,120. And then we're going to credit equity investment for $13,120.
And when you're giving these numbers, and sorry, I didn't do it here. I should have. Let me just put it here. It's the 87,400 times 32%, right? That's where we're getting that number from. And for the cash, it is the 41,000, right, Madeline? The 41,000 multiplied by 32%. That's what we are recording as the dividend, 13,120. And what are you crediting here?
And then we're going to credit equity investment for $13,120.
And I'll just repeat, I know I'm being a stuck record, but you may also need to call this investment in equity affiliate per the textbook. Okay, so that's the recording of the dividend. We've done all the journal entries, correct?
Yes.
Yeah, so we're done. So thank you for that. If you wanted to say what's the balance on the investment at the end of the year, sorry, I'm making this too small now. What's the balance on the investment at the end of the year? You would just add these two and subtract. So if for anybody who calculated this, the ending balance would be 109,600. Okay, that wasn't required. I'm just giving it in case someone did do that part of the work. Questions, anybody? Anything that you, thanks Madeline, anything that you need me to explain further? All right. So in the time we have left, I just want to I've marked the stuff that we didn't do, and I'll see how much material I have to cover in chapter 13 and see if I can take a little bit off you know, on Wednesday. But for the time we have left, I just want to look at 13 and 14. They're going to be really quick, and then after that, if we have anything left time-wise, I'll go back to 7, 8, and 9. But you will get a solution spreadsheet that will have the solutions for everything on it. I realized I was about to put it up, but then I realized that I hadn't put the solution for 11 and 12 on the spreadsheet. So I'll do that, and then I'll make sure that that solution spreadsheet is on Blackboard. All right. So let's just look at these last two things here. They're actually to do with impairment. They're very quick and fairly easy, but I do need to go over it with you. A few times now when we've discussed investments, we've discussed something to do with, well, if there's an, as they call it, other than temporary impairment of the investment, or, you know, decrease, other than temporary decrease of the investment, an investment may be impaired. And for whatever reason, both of these examples are bonds, but, you know, it does apply to the other investments as well, the equity investments. So basically what the accounting principles require is that when we have an impairment of the investment, we actually have to take the loss in the period when it occurs. This should sound familiar because it's the same thing that we did when we worked with inventory, right? We had a loss if the, you know, if the inventory's market value or whatever was less than cost. We did the same thing in chapter 11 where we worked on property, plant and equipment and other types of assets that were impaired. Now we've got the same thing here with securities or investments that are impaired. And so I'll just show you, you know, fairly quickly how we treat the investment. So there's not going to be a surprise here. Okay, we're going to figure out the amount of the impairment, and we're going to debit loss on impairment and credit the investment. Okay, that's basically what's happening. But I just have to make sure that we cover that part of the material so that it's not a shock to you if you see it somewhere, you know, in the homework or whatever. So number 13, that's what I'm going to do first. Hillsborough Company has an available for sale investment in the bonds of Shiloh Corp. Remember, available for sale is not out to maturity and it's not trading. It's kind of, you're holding it, but if, you know, the situation improves, you may sell it and all the gains and losses go to other comprehensive income. But here you've got a potential impairment that's not going to go to other comprehensive income. That would go straight to the income statement. Okay, so the bond has a carrying and fair value of 70,000. So that's, you know, the current situation at 70,000. Hillsborough determined that due to poor economic prospects for Shiloh, the bonds have decreased in value to 60,000. So they have a $10,000 loss built in here, right? They're saying they have a carrying value of 70,000. That was the fair value, but now because the situation has deteriorated at the investee, there's actually a $10,000 loss, potential loss. It is determined that this loss is other than temporary. You know, who knows how these people's minds work? They call it other than temporary. Another word for that is permanent, okay? That it's a permanent loss. For whatever reason, they choose to phrase it as other than temporary. But what we're saying is it's something that's not going to go away soon, okay? It's probably permanent. So they're asking us to prepare the journal entry, if any, to record the reduction in value. So the reduction in value is $10,000, going from 70,000 to 60,000. This is a debt, right? It's a debt investment or investment in bonds, however you want to call it. So I'll go over here and just show you, it's literally a two account journal entry, right? So exercise 13. Again, this is impairments that we're dealing with, right? So you're going to say loss on impairment. And it's going to be the 70,000 that you had minus the 60,000 that it should be. So it's going to be 10,000 is the loss. And the credit is just going to go to investment in bonds, like how we were doing it before, investment in bonds. All right, that's it. That's the journal entry for the impairment. Questions, anybody? Okay, and then how about number 14? It's kind of more of the same. This is asking you for the journal entry to recognize the impairment. And what is the new cost basis of the municipal bonds, all right? So Hager Corporation has municipal bonds classified as available for sale also at December 31. These bonds have a par value, so that's the face value of 821,000 and amortized cost of 821,000. So they were obviously not bought at a discount or a premium. They have a fair value of 759,425. So you can see that the fair value is less than the carrying value, which is amortized cost in this case. Okay, so there's obviously some type of loss that's happening there. The unrealized loss of 61,575 previously recognized as other comprehensive income. So that's this loss that they're talking about, the difference between 821,000 and 759, right? Let's get out my trusty calculator. So 759,425 minus 821,000, 61,575. So this loss that was previously recognized in OCI, other comprehensive income, and as a separate component of stockholders' equity, which is accumulated other comprehensive income, but it's now determined to be other than temporary. That is, the company believes that impairment accounting is now appropriate for these bonds. So this is a little bit different to this question, because in this question, they didn't have a previous loss that was already in OCI. They didn't have any loss. So they just sent a loss through the income statement. Here you've got something that's stuck in OCI that now has to go into the income statement. So prepare the journal entry to recognize the impairment and what is the new cost basis of the municipal bonds. So there's no I guess, secret here that the new cost basis is going to be the fair value. This is what we run into a lot with impairment when you're writing the asset down to fair value. So fair value becomes the new cost. Okay, we had this in the other chapters as well. Cost is, or fair value is cost, or is the new cost. I don't want to say something that becomes too confusing. Fair value is the new cost basis following an impairment journal entry. So that's the question. Now it's like, so what do we do with this? Well, in a departure from what happened above here, we need to get this loss out of other comprehensive income, which is an equity, stockholders' equity account, and into net income, right? Because the loss has to go through net income, because it's no longer a temporary loss, it's considered other than temporary, which is permanent. And then we have to say that the bonds are at a new cost basis of 759,425. So first of all, does anybody have questions about this? Because it's a little bit involved. Anything that needs clarifying before I go through the solution? So here goes the solution. So this is exercise 14. Again, just these two examples of impairment that we have. I think the book has a few as well. All right, let me just bring the debit and credit across. Obviously. All right. So what's going to happen here is that you're going to have the loss on impairment. And I want to be clear here that this is going to go into net income, okay? And it's going to be the same 61,575 that's in the question. But instead of crediting the investment, right, you are going to get the previous loss out of OCI. So it's just going to be called, we had this before in another example, when we were selling an investment, right? So it's a reclassification from OCI. That's the credit. It can't be the investment itself, because the investment that's not where the credit needs to go. We have to get the previous loss out of OCI. So I'm going to write over here, this gets the previous loss, which was a debit, out of OCI. So we can recognize the impairment in net income. Okay, that's why we are doing this. So I'll give you a minute to think about that and see if you have any questions for me about that. All right, so that's the journal entry for the loss. I just want to see if where we did the reclassification from OCI thing. I'm dreaming that we did that. It's possible. Yeah, I don't know why I feel like we did that. Maybe I made up a question on the fly and that's why I can't find it though. Oh, it was in, of course, it was with the bonds. That's why, yeah. Reclassification adjustment, OCI. So maybe I should be clearer and put it. This is fine. I mean, you can call it reclassification adjustment or reclassification from OCI. Okay, so that's the end of the exercises that I planned to cover. I was hoping to have some more time to go over even more fair value adjustment questions, but the time is against us. One thing that I just want to mention at the end here, as we close out the chapter, is that there is something called the fair value option. And what this really just means, this is, we're just talking about the theory behind this. We don't have to do any examples on this, but you should just know that it exists. The fair value option says that companies can choose, when they purchase an investment, to account for that investment at fair value through net income. So even an equity method investment, when they buy the investment, they can choose, again, at the time of the purchase, right, that they want to account for the investment at fair value. That can be the same for an available for sale investment, that they want to do fair value, but they want to do it through net income, right? So all gains and losses are reported in the income statement. That's the biggest difference, right? And it's generally when you first purchase the investment that you make this decision. You can also do it for liabilities. It doesn't just have to be assets. So if you have some type of liability where you borrowed money, you can also account for it at fair value. All the gains and losses go through the income statement. If you choose this option, you have to stick with it until you sell the investment. You can't change back to amortized cost or something like that. You'll have to stay with this option basically forever. And this is often helpful when, and this year you really don't need to get into all of this, but sometimes some companies do something called hedging, where they know that they have an investment in a particular security, and then they go and invest in something else that will help them, that if they make losses in this security, the gains on this one will be able to balance it out. That's called a hedge, right? A hedge is something that protects you, just like a hedge in your garden. So hedging means that I have one type of investment and then I go look for another type of investment where they basically move in opposite directions. So that if I'm losing here, I'm gaining, so I can end up in the same place. So just know that the fair value option exists, that for any investment that is not fair value through net income, the company can elect to do fair value through net income for that investment, but they have to stick with it for the entire time that they own the investment. All right, so that's chapter 12. You're in a position now to be able to do all the homework. I'll make sure that I update the solutions. I mean, you have access to the class example sheet, but also the formal solution sheet, I'll update and post if you want that as well. All right. Anybody have any comments, questions, something? We've still got a few minutes, something to do with the chapter that you want to bring up? All right, so moving on from here, we have chapter 13 and 14. 13 is current liabilities, which is, not too bad. And then 14 is long-term liabilities. So we should be okay. In 14, we'll see the amortization table again that we were just doing. Again, just a reminder about the term research paper due on Wednesday at 6 o'clock. Here's all the information about part A and part B. In my version of this thing, I think I was talking to someone long ago who asked me how to present the financial highlights, and I kind of just threw this up really rough. Just saying that your best bet is probably just to put the name of the item, the year, 1 year over, the previous year and the current year. Remember, you're working with annual financial statements. Please don't do quarterly or whatever. I have to mark 18 papers. I need you guys to be consistent with using the most recent annual report. Otherwise, I'm going to deduct points because you are given instructions that it's the most recent annual report. I need to be able to find the numbers that you are working with. You have to put a reference. So if you found these numbers on page 2 of the annual report, then put that reference in parentheses at the bottom here. If you wrote this out in words, that's fine. I'm just saying for the stragglers who still haven't done the work, if you're wondering how to do this, whatever the most recent annual report is of your company, put those numbers here. The year before, put those numbers, calculate the difference between the two, calculate the percentage difference, and then discuss, right? What you think about the changes in the numbers. And then here for liquidity, solvency, and profitability, I'll repeat again, you do not need to explain to me what is liquidity, what is solvency, what is profitability. I need you to choose 3 or 4 ratios under those categories to calculate 2 years worth of ratios and discuss how the company is doing. So most of the time for liquidity, people will do current ratio, but do it for 2 years so that you can actually see if the company is improving or not. For solvency, they do like debt to assets or something like that. And for profitability, they'll do profit margin, right? You can choose which ratios you want to do, but please make sure that you do at least 2 years ratios so that I can, or you give me some type of idea of what the trend is for the company. Just doing 1 year's worth of ratios and telling me, this is the number, that's not really good enough. Remember, your friend is trying to invest in the company and you want to see at least to some extent how the company is doing. For the share price, I told you before, you can copy a graph of the share price for the previous year. You can put into your paper and then, just reference where you got that from and maybe just mention whether the price has gone up or down when you speak about the share price. And for the news reports, it's just 2 stories and you really only need to write 2 or 3 sentences about each of the stories. You don't have to tell me everything that's happened with the company. Remember, it's 2.5 to 3 pages. Okay, so please don't go overboard. And again, double space typed, referenced APA format, no plagiarism, reference your sources, whatever the sources will be. Do not use Wikipedia. Please proofread your work. If there's anything else that people have questions about, I'll stay on the line. But other than that, go and have a good day. And I'll see you on Wednesday. And again, if people have questions for me, I'll stick around, or you can come to office hours.